Almost all the major Indian indices, including the mid cap index, are near lifetime high. So, in this bull market, let's today do a detailed analysis of one of the popular mid cap fund, that is PGIM India Mid Cap Opportunities Fund, and see whether we should continue our investment in this fund or not. Earlier also, I had made a video on this fund. Links are attached in the I button and in the description. Hello everyone, I am Dhaval and welcome to my channel DIY Finance. Let's start the video with the basic details of this fund. First, the AUM, that is the total asset under management, which is around 10,000 crores, which I feel is on the lower side as compared to other funds in the category. While the expense ratio is 0.45%, which is almost at par with the other schemes in the category. The benchmark index, that is the reference against which the scheme is compared, is Nifty Midcap 150 TRI. Now let's look at the fund's trailing returns. From the table, it is quite evident that the fund's performance has been okay for 5 years and 7 years period and is just able to beat its benchmark and category. But if you observe, for 3 years and less, it is not able to beat its benchmark and the category. Hence, seems that in the recent times, the fund has not been performing good. But as always, I have said, trailing returns do not give a clear picture of the fund performance. So for that, let's look at the calendar and rolling returns. Firstly, the calendar returns. Here we have the data from 2014 to 2023, and for the entire period of 10 years, the fund has underperformed, leaving aside the year of 2020 and 2021. Hence, from this data, we can say that the fund is not that consistent in its performance and had good performance only in the year of 2020 and 2021. Now let's also check the fund's monthly performance for the last 12 months. Here if you observe, the fund is able to beat its benchmark and category in the month of May 23, October 23 and February 24. That is 3 out of 12 months, and that also with a very less margin. And rest of the 9 months, it has usually underperformed, which clearly speaks that the fund's performance is quite poor. Now let's also quickly check the rolling returns. Here we have rolling returns data for 1 year, 3 years and 5 years. If we observe the 1 year rolling returns, the fund is able to beat its benchmark 54% of times with a negative return chance of 22%, with an average return of 21.21%. Now let's see the 3-year rolling return. Here also the data is not that good. The fund is able to beat its benchmark 53% of times with an average return of 19%. Now finally, let's look at the 5-year rolling returns. Here the fund is able to beat its benchmark 77% of times with an average return of only 16% with almost no negative returns. Hence, from the rolling returns data, we can conclude that the fund's performance is not that good, but is an below average performing fund. From the past performance data, what we have seen till now do not indicate that the fund is a good performing fund. But past data is not always an indicator for the future performance. So now let's see what we can expect from this fund in coming times. For that, we'll look at the fund managers and we'll also do a detailed analysis of the fund's portfolio. So firstly, let's look at the fund managers. Mr. Vinay Paharia has taken over from Mr. Anirudh Naha in April of 2023, that is, since last 1 year. And as seen, the performance of last 12 months are also not that encouraging. Mr. Vinay Paharia has also been joined by Mr. Anirudh Anjania in August of 2023 and by Mr. Utsav Mehta in November of 2023. Surely, we can say that we should provide some more time to the fund manager before we take any decision. So now let's look at the fund's portfolio and we'll start with its sector-wise allocation. Here in the graph, if you observe, highest weightage is given to consumer discretionary sector, which is around 21%, followed by financial sector with around 18% and industrial sector with around 17%, followed by healthcare and materials with around 12% each. And when we compare this sector allocation with its benchmark, the allocation is quite different except for the healthcare and the material sector. Generally, healthcare and material sectors are considered defensive sectors. Now let's look at the top holdings and asset allocation. Dixon Tech, Tube Investments, and Unominda are the main stocks of the consumer discretionary sector, whereas Cholamandalam, Kotak Bank, and HDFC Bank are the main stocks of the financial sector, whereas Max Healthcare is from the healthcare sector. Here, the stock selection seems good, and quite popular stocks form the part of top 10 stocks of the portfolio. Now let's check the portfolio allocation. Here if you observe, mid-cap stocks form around 64% of the portfolio, whereas large-cap stocks form other 34% of the portfolio, and less than 2% is allocated to small-cap stocks. The lower allocation of small-cap stocks should make the portfolio less volatile. Let's see this in the later part of the video, whether really the fund is less volatile or not. The portfolio seems little concentrated as there are only 73 stocks and the top 10 stocks form around 24% of the portfolio, whereas top 3 sectors contribute to around 41% of the portfolio, with around 12% coming only from the consumer discretionary sector. Here, the portfolio PE and PB are also on a quite higher side, which suggests the fund has more growth stocks in its portfolio. So, before concluding what investors should do, let's quickly look at the risk parameters of the fund. Here, we compare the parameters with the benchmark index and the category average. First one, mean returns, that is, the average return in a year, which is 20.46, which is lower than both the category average and the benchmark. Here, higher the value is better. Second, standard deviation, that is, a tool to measure how much the returns have deviated away from the mean returns, which in this case is 13.52, which is less than both the category average and the benchmark. Here, lower the value is better. Third one, Sharpe ratio, that is a tool to measure the risk adjusted return, which is 1.12, which is lower than both the benchmark index and the category average. Here, higher the value is better. Fourth one, beta, that is the volatility of the scheme compared to benchmark, which is 0.82, which is less than the category average. Here, lower the value is better. Fifth one, alpha, that is a tool that measures how much better the fund has performed compared to its category. Here, it is minus 1.90, which is quite lower and should be a positive number. Here, higher the value is better. From the risk parameters, it can be concluded that the fund is less volatile, but is not able to generate better returns than its benchmark and the category, which I feel is not desirable for a mid-cap fund. Now let's see the upside and downside capture ratios. The upside capture ratio is the measure of how the fund performed relative to the index during the period when the index rose. Here, the value is 78, which indicates that the fund underperformed 22% more than the index during the rise period. Here, higher the value is better and should generally be more than 100. The downside capture ratio is the measure of how the fund performed relative to the index during the period when the index has dropped. Here, the value is 85, which indicates that the fund declined 85% as compared to the index during the fall period. Here, lower the value is better. The capture ratios are also poor, and especially the upside capture ratio, which is negative, which do not indicate great performance in coming times. So now coming to the conclusion, what investors should do. But before concluding this video and suggest what investors should do, I would request all of you that as you have watched the video till now, it seems that the topic is of your interest. Hence, I would request all of you to hit the like button and also subscribe to my channel if you have not done till now to watch such interesting videos in future also. Here, I would like to clarify that this is not a buy or a sell recommendation and one should take decision by himself or after consulting his or her financial advisor only. This video I have made for educational purpose only and my aim is solely to provide a real insight into funds data. Please do not mistake this as a buy or a sell recommendation. So now let's look what investors should do. First, the existing investors. The fund's performance has not been that good in last almost 2.5 years, as well as fund has not been that consistent in its performance also. But the overall performance, what we see in the trailing returns, is due to the outperformance of 2020 and 2021. If you also observe, the performance is not that good in last 12 months after the introduction of new fund manager also. So one can clearly think of exiting this fund. This is my personal opinion. Second, the new investors. The fund's performance has not been that great in last almost 2.5 years, and hence one can look at other consistent and good performing funds from Kotak, Quant, Nippon, or SBI. You may consider this fund only if you are very confident on the present fund manager, Mr. Vinay Paharia. This is my personal opinion, and I may be wrong in coming times. So, what do you feel? Please feel free to share your opinion in the comment section. Would love to know your views on this fund. I would like to add that presently I have PGIM India Mid Cap Fund in my portfolio and is planning to exit this fund shortly. I will again try to review this fund after 6 to 7 months and check its performance. So stay tuned to my channel. Please subscribe to my channel if you have not done till now, and also press the like button. Do check my older videos. Click the attached cards to watch these videos. Thank you and see you again in my next video.